If you hold Bitcoin, you need to hear what erupted between JP Morgan and Michael Saylor. This drama blew up across X right in the middle of one of the most important macro moments of this entire cycle. And most people only saw the fire on the surface, superficially. However, there is always a deeper story running beneath whatever you see in the news and in the media. And today I want to walk you through it. So stay with me until the very end, because once we break down what actually happened, I'm going to explain the bigger economic engine behind this whole moment. It is the framework that shows why these corrections appear, why liquidity drives every cycle, and why Bitcoin fits the structure of the system so perfectly. Once you see that bigger picture, this entire moment clicks into place and makes sense. So all right, let's get into what really went down. All right, getting started. I know this controversy keeps showing up on your feed, and you're probably wondering what's actually going on. So I want to break it down as clearly and neutrally as possible. So this whole thing started when Bitcoin and Strategy stock both dropped sharply with no clear trigger. When a move like that hits without an obvious headline, the internet fills the empty space with theories, and they spread it fast. And one of the biggest narratives came from posts suggesting Strategy might be removed from major indexes like the NASDAQ 100 or the MSCI index. If that were to happen, index funds would need to sell MSTR, Strategy stock, automatically. And that idea caught fire within minutes. Then more posts pointed at JP Morgan. Some claimed JP Morgan released a bearish report on Strategy right as the market dipped. And others said the bank raised margin requirements on Mr. Strategy stocks positions, which of course we know can force liquidations if traders don't add collateral. So while none of this was confirmed, simply speculative, we know speculation does not wait for confirmation. It's like a rumor. People like rumors for some reason. So the story kept gaining momentum. And that's when emotions jumped in. An old video of Eric Trump resurfaced where he talked about JP Morgan targeting his family's businesses. And right after that, Grant Cardone coincidentally announced he closed his JP Morgan account and moved his money. So that pushed everything into full-on movement. People shared screenshots, videos, and hashtags calling for a boycott, and the rumors completely took over. And in the middle of all this, Michael Saylor stepped in with an official statement to calm things down. He laid out his company's strategy structure in simple terms. And he said, the company is an operating business with a software division that brings in about $500 million in revenue every year, and that they also run a structured finance strategy built around Bitcoin. And that strategy is how they issued more than $7 billion in new digital credit products this year. He also made it clear that index classifications do not define their business and do not change their mission in any way. However, even after that statement, speculation continued flying. Matt Kaiser hinted at government interest in Strategy and Coinbase, and others talked about possible major short positions. And there still isn't any official update backing any of this up, but we know once a narrative takes off, people start trading emotions instead of facts. And this is where most people stopped paying attention. The drama was loud, but the real story was happening underneath it in the liquidity data. So let's take a look at the liquidity squeeze behind this crash. We saw a similar setup during the 2019 repo crisis when the system ran out of easy liquidity. And right now, reserves sit on low again. And the Fed is set to pause quantitative tightening, we know, on December 1st. That is a meaningful signal. US banks, we see, have also started lending more in November, this month. And lending only picks up when liquidity begins turning. And we see there are changes inside the Fed as well. Governor Christoph Waller says he is pushing for a rate cut at the December meeting. And Goldman Sachs expects 3 cuts going into 2026, starting in December. So moves like this show us that policymakers see the end of their tightening path. And something very important to keep in mind here is the United States runs a $2 trillion deficit. And when deficits reach this level, this magnitude, the government depends on liquidity. A slowdown makes that deficit even harder to support. So the system naturally leans towards easing. Treasury commentary points towards growth this next year in 2026, which is what I have been saying lately, is that I believe we are going to see bullish behavior in the market next year just because of everything going on and happening and going into effect next year. And we know that election cycles often create incentives for stronger markets. And you can see some of that positioning in the confidence shown by Treasury Secretary Scott Bessent. So these facts, these insights that they show us that the liquidity cycle has not faded. It hit a wall and is beginning to turn. And smart money recognizes this before the headlines do. So, all right, let us walk through this shift. Because while we see that retail traders have continued to panic, the biggest players, the biggest investors in the market and in the world are doing the exact same opposite, which always happens. These investors, these smart money investors in whales, have been positioning themselves for a turn in liquidity. And institutional investors cut their cash allocations to 3.7%, which is the lowest level in 15 years. And that number matters because big institutions only keep cash on the sidelines when they expect risk. When they hold almost no cash, it means they already move their capital into the market. They are overweight global stocks, overweight commodities, and leaning heavily into risk assets. They positioned themselves early and have been continuing to, is what we see. For example, New Jersey Pension Fund disclosed a $16 million purchase of Strategy of their stock, right around the same time that Tom Lee's Bitmine stepped in and bought $82 million worth of ETH. And then we see some signals coming out of China. Officials there have begun hinting that Bitcoin mining activity could open back up again, which is a meaningful shift for global hash power and sentiment. And while all of that has been happening, Solana has started leading US social dominance again and has rolled out a new disinflationary proposal called SIMD/0411, which is a change designed to slow token emissions without cutting rewards. And take a look at this. Stablecoin dominance has attempted to break higher several times this year and failed again. We know stablecoin dominance only falls when money flows out of stablecoins and into crypto assets. And here is the simple way to look at what's been happening lately. Retail traders reacted to the price drop. Not shocking. Institutions reacted to the liquidity data. Also not shocking. This is what they do. They do the opposite of what the mass public is doing. That's why the famous investment quote goes, be fearful when everyone else is greedy and be greedy when everyone else is fearful. And that is what these whales, these smart money investors, that's what they do. But all right, now let's look directly at how Bitcoin has behaved during this entire shift. Bitcoin's RSI fell into a range that only appears during major washouts. There have been 6 moments like this in Bitcoin's entire history, and every one of them has lined up with capitulation followed by recovery. Short-term holder MVRV also dipped below its lower band, which, once again, has only happened when recent buyers are underwater and long-term investors begin absorbing supply, right? Capitalizing on the sale. And we also see that SOPR reached levels last seen during the COVID crash, the China mining ban, and the Luna and FTX collapses. When SOPR drops this low, almost everyone selling is locked in a loss, which usually marks the exhaustion point of sell-off. And market behavior backs that up. The Coinbase premium, for instance, stayed negative for 1 month, which shows US traders were selling harder than the global market. Bitcoin, we see, also fell 8 Mondays in a row since 126,000, which points to routine and forced selling. Meanwhile, ETH has shown the same exhaustion. Its RSI has dropped into deeply oversold territory and is settled inside a falling wedge pattern. And here is something worth paying attention to. Ethereum tends to respond well to major upgrades. And after the previous upgrade, Petra, ETH saw a move higher once the dust settled. Now, the Fusaka upgrade lands 2 days after the Fed pauses QT, so on December 3rd, which adds even more timing clarity to this setup. And this last signal brings it all together. Swiss block's risk-off indicator collapsed, showing the market is running out of sellers and the flush is cooling off. So when we stack all of this up together, the picture becomes very clear. This was a liquidity flush. It cleared out leverage and emotional selling at the same moment the liquidity cycle began turning. And that takes us, all of this brings us into the most important idea of today's video. And this idea comes to us from Raoul Pal and Julian Bittel, 2 top macro analysts and investors. And I want to break it down for you in a very simple way because this long-term mindset is extremely important. There is essentially a basic formula behind economic growth. Growth comes from population, from productivity, and from debt. And population growth has slowed for 2 decades. Productivity growth has slowed as well. So the system has leaned harder on debt to keep growth moving, and households and companies have slowed down their borrowing since 2008. So governments have had to step in and fill that gap. Public and private debt, for instance, now sit around 200% of GDP, which means interest payments absorb most of the growth. And when this happens, central banks create liquidity to keep the system running. Liquidity, therefore, becomes the engine because it keeps the debt cycle from stalling. This structure means debt expansion is part of how the system stays alive. And when central banks increase liquidity to support that debt, assets with fixed supply tend to strengthen over time. And Bitcoin fits this environment, this setup, this structure, because it has a predictable supply, a predictable issuance schedule, and it operates outside policy decisions, thank God. So once you understand this code that I just broke down here, pullbacks start to feel different. They feel less like chaos and more like the natural rhythm of a system that runs on liquidity waves. It helps you understand the cycle behind all the superficial noise. So here is what this entire moment comes down to as we wrap up today's video. The JP Morgan drama pulled everyone into the drama, and the headlines amplified it, as they do, which is why I never encourage you to listen to or take seriously the fear or perspectives major news outlets try to spread, because they're essentially designed to amplify drama. And that's why we always need to do our own research. And that's why I encourage you to stay tuned here on my channel, because I do my very best to bring you news that is unbiased. And if I do share my bias, my own perspective, I tell you it's mine and why. Anyway, what we do know is that liquidity reached its tightest point and that the cycle hit a wall and the data started turning before anyone noticed. And institutions saw that shift early. On-chain signals confirmed the exhaustion. Market behavior lined up with the classic flush. And when you understand the bigger economic engine behind all of this, the same framework Raoul Pal and Julian Bittel outlined in the Everything Code, the whole picture becomes clearer and quite understandable. This system runs on liquidity waves. When liquidity expands, fixed supply assets strengthen. Bitcoin is built for that world. So the next time a moment like this hits your feed, your news feed, step back and look at the greater cycle. Go check out liquidity. Look at how the biggest players are positioning. Are they buying? That is where the real signal lives. Pullbacks feel different once you understand the structure behind them. This was a flush, not a fracture. Bitcoin's going nowhere. It's only going to $1 million. And the cycle that matters is already turning now. Bitcoin was made exactly for what comes next. So if you found value in today's breakdown, make sure you like the video, subscribe, and turn on the notification bell so you stay plugged in to these moments, because I'll be covering them all for you Monday through Friday. And once again, I hope you're not scared of the turbulence you see in the market. I hope you're not moved by the little swings. I hope you only stack sats. I hope you stay steady, stay plugged in. I love you guys so much, and I'll catch you guys here tomorrow. Ciao.